Hi all, Joshua Stega here from ETFadviser.com.au, and today I'll do my usual weekly rundown of the Aussie ETF market and what investors should be looking at for the week ahead. The three things I'm going to cover off today: we're going to look at the US correction and see where we stand on that at the moment and where things lie. Number two, I'm going to look at those precious metals and see how that impacts on the commodity space and what our thoughts are there. And number three, I'm going to touch on emerging markets and why I think that's still a really key part of the ETF market we should be watching. So let's get started. So point one, we want to look at we've been talking about the US correction. We had a few lines in the sand, and now let's just update and see exactly where we're at with that at the moment. So the key thing we were watching there was the volatility index, so the VIX. And you can see, basically Trump came out with further tariffs on China and we had a spike in the VIX. And that's quite typical for that October kind of period. But what's been really interesting over the past week is it's come right back into the lows and it's kind of sitting on that 50-day moving average. So, if we look back to April, you can see it could have quite easily spiked right up into those, into that 40 mark, but it's kind of topped out at 25 at the moment. So, are we only here and then we're going to have a further spike later, or is that all for now? At the moment, it's obviously a very good sign in terms of the correction kind of being, not as bad as expected, because it was certainly looking like a bit of a base there that it could have rallied out into and gone to those previous highs, which means more volatility, would have been more big moves in the market and potentially more selling. So that's a very good sign. And let's just touch on where we sit in terms of seasonality. And you can see this is the VIX seasonality. Going back 20 years, and you tend to have a volatile period in March and April, which is what we had this year, and then another volatile period in October. So at the moment, and it kind of spikes around that 25, and obviously April was quite significant in terms of the correction we had then with the initial tariff announcements in the US. But it looks like we've spiked it around that 25 level for October, and it's starting to come back in. So you can see, even though we spiked, closer to 40 at the start of the year, around 25, seems to be within target and has come back in. So we'll certainly be watching that in the week ahead. But in terms of the S&P and the NASDAQ, it looks very constructive, back near highs, held that line in the sand. So we've been saying that the last few weeks, that initial pullback, we didn't want the market to go much lower. You've seen the 50-day come up and it's just held and it's kind of broken out to new highs. It'd be interesting to see how we go the week ahead. Obviously, we've got some distribution days there. You can see the red bars, but it's kind of, 50-50 with buying at the moment. So pretty good signs there for the US market. And same with the NASDAQ as well. There was our line in the sand. That was the initial correction. We didn't want the market to go lower than that, and we thought if it could, be a quick 5 or 10% fall. But this looks pretty constructive, and we'll just see what happens from here in the week ahead. Obviously, the NASDAQ had quite a bit more distribution. You can see those high volume selling days. We'll just watch that in the week ahead. And then the small caps as well. So we've been talking about that with subscribers, that the small caps looked like a very V-shaped rally. And what was needed was more time here just to build out that kind of left-hand side, the right-hand side, to be able to get through, these previous levels of resistance back here. So now we've kind of got that, and we're kind of building that right-hand side. You can see it's kind of can't really build out through into new highs yet. So that's why you kind of need that energy to build. But that looks quite constructive as well. The selling, hadn't been as great and actually never touched that 50-day and recovered above, dipped under the 20-day, but has, never kind of spent 2 days under that 20-day moving average. So that's a really interesting sign as well, and quite positive. So one of the big factors at the moment is central banks are really starting to cut rates now. And you can see in terms of the number of central bank policy rate cuts, this was post GFC. We had 313 over a 24-month period. In the COVID correction, we had 255, and at the moment, over the last 24 months, we've got 312 cuts. So this is going back to GFC levels of interest rate cuts. So pretty amazing considering that no one's really in a recession at the moment. So amazing levels of interest rate cuts. So that's something that's really starting to pump up the markets. That's one thing that's in play at the moment. Obviously in the US, you've got an AI boom as well, so that's driving things. But what's interesting as well is that the European markets actually look quite good. It wasn't that long ago that we were getting quite concerned. So around here was obviously looking quite weak, but it's just kind of found those buys again. And you also got to remember that the European market was one of the first to kind of bounce out of that tariff correction. That's what it did. It's done nothing, and now it's just creeping out, and that's pretty much a breakout there into new highs, and pretty constructive one at that. So quite similar to what we've seen in Japan also. So it had quite a similar look to that, where it had that initial bounce, if you have a look on the weekly chart. And there's that kind of that big long base, then all of a sudden out of nowhere it just starts creeping away. And Japan's obviously really in trend there at the moment as well. So if a market can hold those key levels and just start making higher lows and not showing much selling, then it's just going to continue to creep. So I think in terms of the US correction, we'll certainly be watching this week, but with the market at new highs, things are starting to look quite interesting. And actually, in terms of our subscriber ideas for our weekly email, we've actually got 11 key ideas this week. So that's the most we've had since inception. So it kind of shows that things are lining up quite well for the market at the moment. But in general, we're not really looking at indexes. We're looking at sector and thematic ETFs that are going to, I think, give us a lot more upside than indexes from here. So I still think it's very much a stock pickers market, but as to pressure from the market, you've got US markets at all-time highs. You've got that seasonality dropping right off now in terms of volatility, and then you've also got, this is another one to look at, the S&P 500 index seasonality. So when's the market the strongest times of the year for the market? And you can see out of this October period, and that Christmas rally is usually a really strong time for the market. So quite interesting. We've got quite a few things lining up at the moment. Rate cuts, volatility coming down, seasonality for a Christmas rally, and obviously we've got a big week of reporting in the US as well. So we'll see how that plays out. But if things report well and the market likes it, I think we're away for a really nice Christmas rally. Point two, we want to talk about commodities, in particular gold and silver. So obviously that's been on everyone's lips at the moment, a big focus in the media. So let's have a look at gold. And certainly we did call this last week to subscribers, and then we gave a midweek update. So this was the initial point that looks like a top, a short-term top, but certainly you got a high volume reversal bar that, a reversal bar on high volume. So there's high volume selling at the highs that opened higher and then sold lower. So basically we hadn't seen that through this entire rally. So that's the first indication that things were starting to sell off. That recovered quickly the next day, but then the day after that, you got further selling. And so far off about 10% from the highs, and it's held that 20-day moving average. So what we need now in terms of gold, and a lot of the resources as well, we need a correction either in percent or in time. So maybe it's just going to sit there, and that's certainly the correction that we got if you have a look through the middle of the year, where gold had been a really strong performer up until May, did nothing for May, 4 months. There's your correction. Wasn't a correction in percent, it was actually a correction in time, and then was able to run again. So we'll see how that plays out here, but it's had a pretty incredible run. And I was certainly of the view that when gold started selling off, it would be an indication that people were getting back into equities, and that's kind of what's playing out as well. So you got gold, you got silver, did exactly the same thing. That's a little bit weaker, but it's kind of trying to hold that 20-day moving average, but exactly the same. There's, kind of opened higher, sold down over the day on high volume. We've had some back-to-back selling days here now, and good sign is that holding that 20-day moving average, but we do need some kind of correction, either in percent or just time. And I think, this is probably going to be, if this does play out this week and reports are good in the US, earnings and whatnot, and the market continues, or money continues to flow into equities, I think precious metals are off the table for the Christmas rally, and that's probably where you're going to get that correction in time. And maybe now this is a 2026 story. We'll also look at other assets. So what's been interesting in the commodity space now is that we've had kind of a spread. So kind of what started with gold, silver, palladium, platinum, eventually got into copper, and now we're starting to see other assets move as well. So you can kind of see here's copper miners, and they only started moving, where gold started at the start of the year. Copper miners kind of only started moving in August, and so they're quite a bit earlier in their run. And at the moment, we'll just be watching how these correct. But a lot of the mining charts, mining ETFs look like this at the moment, where you've hit the high, you've sold back onto the 20-day. How much of a correction do we need? Is it going to be in price, or is it just going to be in time? But I think the commodity space outside precious metals looks really interesting, and something I'm watching. And so what we had this week was we had a bit of pop-up in oil. So oil's still very much in a downtrend, but it was interesting here. And what is also interesting is that oil is underperforming, say, the oil stock. So here's Van Eck Oil Services ETF. We don't have this in Australia, but you can see that, kind of found a bottom already back in April, and has kind of been trending higher, making higher lows. Had a good move this week. Obviously, still, it's breaking out of that downtrend. This was kind of the week where it did break out of that downtrend. So that's interesting that oil services stocks are moving before oil. But what is also interesting is natural gas, and we've been talking about that to subscribers the last few weeks. But this is starting to look really interesting now as well. And gas is a really key energy source, and it's almost been forgotten. But you can kind of see on the weekly chart, it's been in this long base since kind of 2023. So this is now going to be a 3-year base potentially, and this got us really interested. It did hold so it's kind of broken through these moving averages, held the 20-day here, popped up, and now is holding kind of that 6-day and 10-day moving average. So it certainly needs more time in terms of the way it could shape out. But this is something I'm watching really closely, and it tends to happen in the commodity space where gold, the reasons that are pushing gold, the reasons that are pushing silver and precious metals, that are then pushing copper, that are then start to push critical materials and minerals, and what then is going to start pushing gas. Another one as well that we've been watching is aluminium. So that looks really interesting now as well. So that is now so what's that? That's like another 3-year long base, and you can kind of see how this is formed, and it's just popped out this, that was Thursday, Friday last week. So really interesting. Aluminium, a really key asset for a lot of industrial applications going forward. But the thing about aluminium is it needs a lot of energy. So it's almost a play on energy as well. So interesting to see that that's starting to move, because you need a lot of energy to create aluminium. So that's interesting. We've got coal in the US, so we don't have this ETF in Australia, but coal certainly found a bottom back in April, and there's a nice base that's pulled just in there now, so it's kind of like a cup with handle. We'll see how that reacts here, but that looks really interesting. So that's another one in the energy space. And then also we have steel. So steel, another interesting one. This is pretty amazing out of the US, that this is now a 15-year base that it's just pulling out of now. So this is now on a monthly chart. So this is steel stocks. We don't have this in Australia, but steel stocks in the US, that's a really nice base. They corrected post, so that was the GFC, bounced there, and it now has only got up to a point higher than where it was in 2011. So that is incredible. As they say, the bigger the base, the higher the space. So that's worth watching, really interesting. And just in that kind of general feel as well, you've got Chile, which is kind of is an emerging market, but also has exposure to a lot of resources and copper in particular as well. And we're looking here on a monthly chart, and this is a 5-year base. So once again, the bigger the base, the higher the space, and that's really interesting. That's starting to just break out now as well. So that's telling a story, which will lead us into that kind of next point about emerging markets. But let's just keep that in context, because let's have a look at Peru's ETF. Can these really get moving when they get going? I mean, yes, look at Peru. That was quite a similar kind of, so it was kind of a 2018 to, yeah, it was only this year. So it kind of only went in August as well. That was kind of like another 5-6 year base, and away it went. And what are the actual numbers there? Let's get our measuring tool out. So just from August to where it is now, that's 30% for a country ETF. I mean, unfortunately, we don't have that in Australia, but that's telling a story. So commodities and emerging markets are somewhat linked. So still very excited about commodities space, and we've got quite a few ways to play that. But it just feels like they need a little bit more time. So maybe if I have a look at BHP, you know, some of the majors haven't really done anything yet. So that tells quite a story as well, that the big funds are probably still underweight resources and are starting to readjust that. So this is kind of the stage 1 base. And this is once again, you know, forming really nicely. He's trying to get out, but we've got the same happening. Rio probably looks a little bit better on the Aussie market. So once again, another kind of stage 1 base that it's trying to move out of. And then we consider like Glencore as well. So that's another major resource player, and that's listed in London. And we've got another stage 1 base here as well. So the commodity, and this actually looks really constructive. You kind of have your 3 compressions, nice pullback here. I mean, when these start to go, it's all systems go for resources again. It means the big money, which can't play in a lot of those small cap stocks that have really moved in Australia, the small cap mining stocks, they need to then go and buy Glencore, BHP, Rio. That hasn't started yet, and that has a long way to go potentially. If, for example, a big equity fund is saying, well, we've been underweight resources for the last 10 years. That's been the play. And now we need to go back to market weight or overweight. That means that they need to quickly start buying here, and that's what could push these big cap stocks to new levels. And that's kind of what will push a lot of these ETFs. So QRE being a key example is about 40% BHP. So that's not really going to move out until BHP gets going. So it's holding here well, but if BHP gets going, I want to be on board because I think there's a lot of potential upside for QRE. And as I said, just that flow of money that's going to come because everyone's been underweight resources for quite some time. So let's then touch on those emerging markets. So we've already spoke about commodities, low US dollars playing out into, stimulating the economies of these emerging markets. And we've seen that certainly the emerging markets, so this is a good post on Twitter, the emerging markets are up about 30% year to date. So they've outperformed pretty much all developed markets. But what's interesting here on this chart is that you've got your emerging markets relative performance. And, it's pretty much a 15-year long base here that they're coming out of. So once again, the bigger the base, the higher the space. But then let's consider that against developed markets. And you can see those periods where they did outperform. So say 94, before the tech boom, that's when they underperformed. Then once again, they performed well post, the tech boom crash. And then that was then into the GFC. They were starting to outperform again. So a similar kind of situation where you had low rates, quite stimulative economy, and then you've pretty much had, because of this, you've had an underinvestment. This is where all investment went into tech, because mainly what we're looking here, developed markets. I mean, obviously the US market's a big part of developed markets, so that's, all the money's into tech, then all of a sudden all the money's into emerging markets and back into resources. What's happened since the GFC? Well, yeah, same thing. Pretty much all the money's gone into tech and no money into resources and emerging markets, and that's only just starting to turn now. So that's breaking out there of a 15-year base. If we were to say that that's going to play catch up, it's going to go from, say, these levels here. There's a long way to go. It's a double, it's a triple, from here, potentially even more. So huge amount of potential performance still to come. And what parts of the market are we looking at to perform? So this is the Vanguard Emerging Markets ETF. And you can see the key markets are China, that's 34%. So 1/3 of emerging markets is China. Then you've got Taiwan. So just those two is 50% of emerging markets. Then you've got India. Then you've got Brazil, South Africa, Saudi Arabia, Mexico, Malaysia. So there's a lot that can still grow outside of this, but in general, there's 50, 60, 70% of emerging markets of those three economies. And Taiwan obviously be a big part of semiconductors, but China hasn't even really moved yet. India has been in a huge base. So let's just touch on India because that's really exciting. We were really keen on that at the start of the year, but it's been quite a bit. It's been quite quiet there. So we've got to remember that India was the top performing market globally. I'll just get that on a monthly chart out of the COVID crunch. So there's your COVID correction, and then all of a sudden India just launches. And let's just measure that in terms of performance from the bottom. To where it got to, that was 250%, pretty much over 4 years or 4.5 years. So pretty incredible move. And in terms of where we're at now, obviously, it corrected in, get it back to a weekly chart. So India reached that high in September 2024, and this is now a perfect base. We just need a little bit more time. I'm probably saying early December, or perhaps it's a 2026 story where it could potentially go just in terms of the way it's lining up. So if that starts moving again, India is a key growth engine, certainly one of the fastest growing economies in the world at the moment. And in terms of the way this is set up, just perfect stage one base again, as I said. So potential for early December, but if that starts running, we could be away again. And once again, the longer the base, the higher the space. So not only do you have one of the most exciting economies in terms of growth, you've also basically got now, it'll be a year and 3 month long base in one of the strongest performing economies in the world. So certainly something to watch. And that could certainly really push emerging markets to new levels. But let's also just touch base on China as well. So here's the China A50. And you can see actually it had a pretty strong move there later in the week. So we'll put that on the monthly chart and just see how significant that is in terms of this kind of base. So we're kind of back to, this is now a 3-year long base and actually looks really quite constructive there now as well. So just a few points that it needs to push out of, but then, that's 1/3 of emerging markets. If that gets going, there's a lot of potential there, even from, those previous highs post-COVID. I mean, that alone is 25% that it just needs to move up to. So that's a huge amount of potential performance for a big market. It's 1/3 of the emerging markets ETF or index. So pretty exciting times, and it's all kind of linked: commodities, emerging markets. The same things that are pushing those areas of the markets can push, emerging markets. And once again, just highlighting, look at the valuation potential. Feels like the same situation post the internet correction, and then all of a sudden people forget about tech, back into kind of real hard assets and resources and emerging market economies, and it feels like exactly the same here. It's had a good run, You know, the tech companies are very highly valued in the US. It's all about AI. If AI doesn't come up to the hype, you know, we've still going to need a lot of resources, and investors going to start shifting to where the growth is fundamentally, and that's going to be India, that's going to be China. Really interesting times. So in terms of being an ETF investor, there's so many ideas and ways to play these themes and sectors at the moment. I think the upsides in these kind of ideas are going to be so much larger than, say, looking at the NASDAQ or looking at the Aussie market. I mean, just as I said, look at China's 25% there. We've got India coming out of a long base. We've got, you know, a lot of these commodities moving out of long bases. So the bigger the base, the higher the space. And with that, I'll finish. And once again, follow the trend. That's what we're all about. Follow the trend, and I'll see you guys next week.